So you want to own a Dollar General. Picture 7,500 square feet of selling space, a red sign off a county road, gravel lot, 8 aisles of bleach and canned corn, cardboard shippers still stacked in the middle, one person on the register, a 20th of the supermarket you actually shop in. That is the dream. Here is the account. Dollar Tree paid $8.5 billion for Family Dollar in 2015. In fiscal 2023, it wrote $1.07 billion of that straight off the books. Same chain, same shelves, same aisles, and the filing never prints the number that explains it, what one store clears in a year. Nothing in that building is decorative. Polished concrete, fluorescent tubes, a freezer case humming at the back, a stockroom that is really just a corridor. Every square foot of it is doing a job somebody put a number on. Start with what you are actually selling. Consumables, food, drink, cleaning products, paper goods, medicine, were 82.2% of Dollar General's net sales in fiscal 2024. 4/5 of everything that crosses the scanner. Seasonal goods were 10.0%. Home products, 5.1%. Apparel, 2.7%. So the shampoo and the canned corn are not a sideline. They are the business, and they are the thinnest margin thing in the building. Gross profit came in at 29.6% of net sales in fiscal 2024, down from 30.3% the year before. 0.7 of a point, gone in 12 months. Now here is the part that runs backwards. A margin sliding like that normally means the expensive goods stopped moving. Nobody bought the winter coats. Dollar General's own account of the year says something else. The rate came down on heavier markdowns, more damaged stock, and a greater share of sales falling into consumables. The cheap end did not shrink. It grew, and it dragged the rate down with it. Now the thing that is missing. Dollar General publishes a great deal about itself. Net sales split by category, store counts by state, selling square footage, how many stores it opened, how many it remodeled, how many it moved. Hundreds of pages, and none of them says what a single store earns. There is no per-store profit line in that document, no rent figure for one building. No payroll number for the 2 people standing on the floor at 9 on a Tuesday morning in a town of 4,000. What you get instead are the 2 ends of a division. 20,594 stores at the close of fiscal 2024. $1.71 billion of operating profit in fiscal 2024. The company hands you the top of the fraction and the bottom of it and sets the pencil down. 2 numbers, 1 division. And the one figure that would tell you whether any of this is worth owning is the figure nobody is required to file. A Dollar General store does not sell cheap goods. It sells a 5-minute drive. Approximately 75% of the United States population lives within 5 miles of one. Not within 5 miles of a Dollar General somewhere in the state. Within 5 miles of an actual store tonight from wherever you are sitting. And more than 80% of those stores sit in towns of fewer than 20,000 people. Those are places a full-line supermarket will not build. Put a proper grocery store in a town of 6,000 and the catchment will not carry the payroll, the refrigeration, the loading dock, and the parking lot, so nobody builds one. The nearest real grocery ends up 25 minutes down the road, and for a household working 2 shifts, that is not a shopping trip, that is an afternoon. Into that gap goes 7,500 square feet of selling space, and the size is deliberate. It is too small to hold a full grocery range, and it was never meant to. Not a small supermarket, a stocked cupboard at the end of the road with a car park. Here is where most people's intuition gives out. If the store is closer, and the word on the sign is dollar, it ought to be cheaper. Measured per unit, it very often is not. In one 2023 comparison, a 2-ounce carton of Goldfish crackers at Dollar Tree cost $1.25, which works out at 63 cents an ounce. The 30-ounce carton of the same crackers at Target came to 30 cents an ounce, less than half. Now that is one item, on one day, priced by a magazine rather than by an auditor, and I am not going to hang an argument on it by itself. But the mechanism underneath it runs through every aisle in the building, and nobody in the trade disputes it. The pack is smaller, the shelf price is lower, the price per ounce is higher, which is the whole trick, and it is not a trick at all. A household buying a fortnight of groceries at once is not the customer. The customer is buying 2 days of it, in the size they can pay for today, 4 minutes from the front door. You are not paying for cheap, you are paying for near. So where does the money actually come from? Not the basket, the building count. In fiscal 2024, Dollar General opened 725 new stores. It remodeled 1,621 more, and it took 85 and moved them to better corners. Over the same 12 months, sales in stores that had already been open a year moved 1.4%. Put those beside each other, and the shape of the thing is obvious. Net sales went to $40.6 billion in fiscal 2024, up from $38.7 billion in fiscal 2023. Nearly $2 billion of growth, and the stores that were already trading produced almost none of it. The growth is buildings, not baskets, not prices, not clever merchandising. Buildings. Put 725 openings on a calendar, and it comes out at 2 new stores, going up somewhere in America every day of the year, Sundays included. Stack the 1,621 remodels on top, and a crew is walking into an existing Dollar General to rebuild it more than 4 times a day, every day, for 12 months, while the registers keep running. Call it a retailer if you like. The day job is construction. Now here is the part that catches people who assume scale buys efficiency. Spread the sales across the estate, and one Dollar General store took about $1.97 million in fiscal 2024. The company reports the same thing per square foot. $263 of sales for every square foot in fiscal 2024, against $264 in fiscal 2023. $1 a foot, backwards. The chain got bigger and every foot of it got very slightly worse. That is not a failure. It is what the model does. Each new store is planted in a smaller town than the last one, because the big towns already have 4. The estate grows, the average thins, and the total still goes up, which is the only line the market reads. Dollar Tree runs the same machine off a different price point. 8,881 stores at the end of fiscal 2024, 525 of them opened during that year, turning $17.6 billion of net sales. Divided out, and one Dollar Tree store took about $1.98 million in fiscal 2024. 2 chains, different signs, different aisles, different price architecture entirely, and within about $10,000 a year of each other, store for store. That is not a coincidence. It is the ceiling on what a box that size, in a town that size, staffed that thin, can physically ring up in a year. So what does it cost to keep one of these boxes standing still? Not to sell anything, just to exist, lit, heated, and open, on a morning when nobody comes. Ask most people where the money goes in a shop and they will say the stock. Of the money that leaves whether or not a customer walks in, the stock is not on the list at all. The largest of those lines is the rent. Most Dollar General stores sit in leased premises, and many of them, including a significant portion of the new ones, run on a primary lease term of up to 15 years with renewal options bolted on the end. That is the company's own wording, and the hedge in it matters. Not every store, not a fixed term. At the close of fiscal 2024, the average lease across the whole estate still had 9.4 years left to run. Now the number. Operating lease cost in fiscal 2024 came to $1.89 billion. That is 18.3% of the $10.30 billion of selling, general and administrative cost the company booked in 2024. Nearly a fifth of everything spent on running the business before a single hour of shop floor labor is paid for. And it is not the whole rent. Sitting on top of it was another $0.39 billion of variable lease cost in fiscal 2024, the portion that moves with sales and pass-through charges. Fixed and variable in fiscal 2024, $1.89 billion plus $390 million is $2.28 billion of rent, before you have bought a single bottle of bleach. Think of it the way a franchisee has to. The fixtures are yours. The building is somebody else's. The rent arrives on the first of the month whether the town turns up or not. Second line, people. Dollar General employed roughly 194,200 across stores, warehouses, fleet, and offices as of February 2025. Spread that across the estate, and the shop floor holds 2 or 3 of them at a time, which is why you can walk the length of a Dollar General at 4 in the afternoon and see nobody but the person on the register. Third line, the Fitout, and this is the one part the chain buys outright. $296 million in fiscal 2024 went on shelving, fixtures, coolers, and registers for new stores. About $408,000 for each new store opened. Racking, freezer cases, point of sale, signage, all of it yours. The walls around it, somebody else's. Fourth line, the estate already standing. $605 million in fiscal 2024 went back into existing stores. Another $343 million in 2024 went into warehouses and trucks. Out of $1.3 billion of capital spending across fiscal 2024, well under a quarter was spent putting up anything new. 4 lines: rent, people, fixtures, upkeep. Not one of them moves when a shopper drives past instead of pulling in. Every shop you have ever walked into picks a product and then puts a price on it. Dollar Tree spent 35 years doing it the other way round, and that inversion is the lever the whole trade runs on. In November 2021, Dollar Tree moved its standard price point to $1.25, ending 35 years in which everything on the shelf cost $1.25. One decision, and every item in every aisle in the country repriced on the same day. Now think about what that does to the people who make the goods. A supplier selling into Dollar Tree does not quote a price. It is handed one. Then it engineers the package backwards. Thinner card, fewer units, a smaller fill weight, until the thing can be manufactured, shipped, shelved, and sold for $1.25 each, with something left for both sides. The ounces are the variable. The price is the fixed point. That is why the carton is small. Not to trick you at the shelf, because the carton was designed in a factory to hit a number that was set before anybody knew what would go in it. By the end of fiscal 2024, about 2,900 Dollar Tree stores were carrying the multi-price assortment. Goods deliberately sitting above the base price point on the same fixtures, in the same aisles. And here is where the payoff turns up, in a place you would not think to look, not in the ticket. The average ticket moved 0.1% in fiscal 2024. Statistically, nothing. It turns up in the door count. Customers came 1.6% more often, and same-store sales rose 1.8%. Almost the whole of that growth is people walking in more times, not spending more when they get there, which is exactly what the pack size is for. A small pack is a reason to come back on Thursday, and it is what the margin rests on. Dollar Tree's gross margin held at 35.8% in fiscal 2024. Dollar General's came in at 29.6%, 6 points between two chains selling largely the same categories to largely the same households. And it is not a merchandising trick. One chain lets the manufacturer decide the pack size. The other lets the shopper decide it. One store, 1 year. Here is the division the filing declined to do. Start with what comes through the door, about $1.97 million in a year. Take out what the goods cost. At the fiscal 2024 gross profit rate of 29.6%, what survives paying for the stock on the shelves is about $584,000. Now take out the cost of running the place. Not just the 2 people on the floor, this line carries the shop wages, the rent, the electricity, the coolers wearing out, and a share of the warehouses, the trucks, and the head office. Selling, general and administrative cost ran at 25.4% of sales in fiscal 2024, which on this store is about $501,000 in a year. $584,000 minus $501,000 leaves $83,000. $83,000. That is what one Dollar General store made in fiscal 2024, before interest and before tax. Check it from the other end, because a rate applied to an average can drift. Operating profit for the whole company in fiscal 2024 was $1.71 billion. It finished the year with 20,594 stores. Divide one by the other, about $83,000 per store. Same answer, opposite direction. That is the figure the filing never prints, and now you have it. Hold that against the building it came out of. A building that puts nearly $2 million through its registers in a year, that carries a lease running the better part of a decade, that needed racking and coolers and a point-of-sale system before it sold anything at all, clears roughly what the district manager who supervises it takes home. Not a fortune, a salary, and that is the good version of the story, because an average is a smooth line drawn through 20,000 buildings that look nothing like each other. It assumes your store is the average one, not the one in the town that lost its second largest employer last year, not the one losing stock out of the back door faster than the chain can count it, not the one whose lease comes up for renewal next to spring at whatever number the landlord decides it is worth, now that there is nothing else on that road. Run the same division on Dollar Tree, and it comes out better. $1.5 billion of operating income in fiscal 2024 across 8,881 stores is about $169,000 per store on about $1.98 million of sales. 169,000 minus 83,000 leaves 86,000. $86,000 a store. Twice the money out of a box on the same road. Where does that gap come from? Not from selling more. Dollar Tree's gross margin was 35.8% in fiscal 2024 against Dollar General's 29.6%. 6 points better on the way in, which is the pack size doing its work. It gives some of that back on the way out. Dollar Tree spent 27.5% of revenue running its stores in fiscal 2024 against Dollar General's 25.4%. 6 points won, 2 points handed back. 4 points survive to the bottom of the page, and on a box this size 4 points is the difference between a salary and 2 salaries. Now put 2 years side by side in the same building. Same lease, same shelves, same town. Fiscal 2023, gross profit rate of 30.3%. Diluted earnings of $7.55 a share in fiscal 2023. Fiscal 2024, gross profit rate of 29.6%. Diluted earnings of $5.11 a share in fiscal 2024. The margin moved by less than a point. The earnings moved by a third. And this happened in a year when sales went up to $40.6 billion in fiscal 2024. That is the whole engine in one comparison. It is worth being precise about why. Dollar General's operating margin in fiscal 2024 was 4.2%. 4 cents of every dollar that crosses the scanner survives to the bottom of the page. When the cushion is 4 cents, a slip you would need a magnifying glass to see on the gross line arrives at the earnings line as a third of the company's profit. That is not fragility caused by bad management. It is arithmetic. Anything running on 4 cents behaves like this. So what is holding the rate up at all? Not the food. The food is the traffic. Seasonal goods, home products, and apparel together came to 17.8% of net sales in fiscal 2024. On one average store that is about $351,000 in a year, out of $1.97 million crossing the counter. That fifth of the shop is where the margin lives. The garden chairs stacked by the door in April, the Christmas lights in October, the throw cushions, the plastic storage tubs, the kids' socks in a plastic sleeve. None of it is the reason anybody got in the car, and it is the first thing a household stops buying when the month runs long. The bleach still goes in the basket. The cushions do not. There is a second problem hiding in that same fifth. Bleach turns over every week and never needs a discount. A pallet of Christmas lights holds its meter of shelf from September and either sells at full price or becomes a markdown in January. And heavier markdowns were one of the 3 reasons the company gave for the rate coming down. The margin-bearing fifth is the risk-bearing fifth. Same shelves, which is the spread you are actually buying when you own one of these. Not a full car park against an empty one. The car park stays busy either way. It is the difference between a year when the household adds the storage tub at the till and a year when it does not. 12 months apart, nothing about the building changed, and the earnings came down by a third. And nothing on the cost side moves with you. The lease was signed years before the bad year arrived and runs for years after it leaves. The coolers draw the same power in a slow month. The shifts on the rota do not shrink because the aisles went quiet. The whole swing lands on what is left at the end, which, on 4 cents, is not much to land on. Which is why 725 new stores in fiscal 2024 matters more to this company than any price it could have set. If the margin on the estate you already own is going to swing like that, the only line you can still rely on is more estate. The break has a name, a date, and a price. Family Dollar. You heard the purchase at the top, $8.5 billion in 2015. Here is what became of it. In fiscal 2023, Dollar Tree took a goodwill charge of $1.07 billion against that business and a trade name charge of $950 million on top of it. Neither of those is cash leaving the building. They are a company writing down, on paper, what it has finally admitted it owns. Then it stopped writing things down and sold. In March 2025, Dollar Tree agreed to hand the Family Dollar business to Brigade Capital Management and Macellum Capital Management for $1,007.5 million in cash. Roughly 7,600 stores went with it. Put the two numbers next to each other. $8.5 billion in 2015, $1,007.5 million in 2025. The sale price came to 11.9% of the purchase price, and that is the headline figure. Dollar Tree put estimated net proceeds at about $804 million in 2025, after the adjustments. 10 years, 7,500 buildings, most of them still standing, still leased, still selling bleach and canned corn to the same streets. And roughly $8.09 gone. Nothing was stolen and nothing burned down. The shelves are exactly where they were. What changed is what somebody was willing to pay for the right to keep stocking them. Dollar General's version of the same failure is smaller, slower, and much easier to miss. In the fourth quarter of fiscal 2024, it booked $232 million of charges from a store portfolio review, store closures, and write-downs against PopShelf, the smaller format it had been opening alongside the main chain. And in that same quarter, the counters told the rest. Customer traffic fell 1.1%. The average transaction rose 2.3%. Fewer people came through the door, and the ones who did spent a little more each. Nobody outcompeted that chain on price. It ran out of towns. And the timing is the sharp part. That quarter was a good one operationally. Shrink. Stock walking out of the door unpaid for. Improved by 68 basis points against the same quarter a year earlier. They fixed the thing that was fixable. The door count still went the other way. Go back out to the parking lot. Gravel. A red sign. 7,500 square feet of selling space behind it. You know what it costs to fill now. About $408,000 of racking, coolers, freezer cases, and registers for each new store opened on a floor somebody else owns. You know what is on the shelves. Food, cleaning products, paper goods, and medicine at 82.2% of net sales in fiscal 2024, the lowest margin category the company carries. And you know why the building is on that particular road rather than a better one. Approximately 75% of the United States population lives within 5 miles of one of these, and it is the ones with nothing else nearby that make the model work. So it does not sell cheap goods. It sells the last 4 minutes of the journey, and it charges for them by the ounce. That is the trade. And in the same 10 years, two companies took it in opposite directions. Dollar Tree bought Family Dollar for $8.5 billion in 2015, spent a decade trying to make the two halves work as one, and let it go for $1,007.5 million in 2025. Keeping the half that runs at a 35.8% gross margin in fiscal 2024 and handing the rest to somebody with a stronger stomach. Dollar General did the reverse. It kept building. 725 new stores in fiscal 2024 alone. Each one dropped into a town a little smaller than the one before it, because the arithmetic only works if the estate keeps growing. Neither of those is a strategy about shopping. Both are decisions about how many boxes to hold. One company decided it was holding too many. The other decided it was not holding enough. Which brings back the figure nobody has to file. 20,000 leased boxes at about $83,000 each is a $1.71 billion business in fiscal 2024. It buys distribution centers, a truck fleet, and a listing on the New York Stock Exchange. One leased box at about $83,000 a year is a job. One person on the register, two on a good day, a stockroom that is really a corridor, and a lease with the better part of a decade still to run. Same gravel, same red sign, same 8 aisles of bleach and canned corn. The only thing that changes is how many of them you own.